The broadcast is now starting. All attendees are in listen-only mode.
And then we should be live.
Hello, good morning and aloha. Thank you for joining Hawaii Realtors for a statewide webinar on FHA and FHA related topics. I'm Ken Hiraki, Director of Government Affairs. Joining me is also Christina Lum, who's our Communications and Marketing Administrator. So I'm here with Esther Yamashiro and Doan of the Santa Ana Homeownership Center to discuss FHA and FHA related topics. Also joining us is Ryan Okahara, the Honolulu Field Office Director for the U.S. Department of Housing and Urban Development, as well as John Gonzalez, who's the Management Analyst for HUD. Let me begin by introducing Esther. Esther began her career with HUD in September 2008. She is the Mortgage Credit Bureau Chief for the Processing and Underwriting Division. She has been a Mortgage Credit Branch Chief since 2012. Prior to joining Federal Service, Esther spent 22 years in private sector mortgage banking, gaining experience in loan origination, underwriting, and funding. Esther is a local girl, born in Honolulu and grew up in Kaneohe. She attended King Intermediate and is a proud Castle High School graduate. Doan is the Director of Processing and Underwriting Division. He's been with HUD since October 2013 and has been the Santa Ana Homeownership Center Processing and Underwriting Division Director since July 2015. Prior to his position at HUD, he was with the FDIC for 4 years as a bank receivership specialist. In the private sector, he has over 20 years of management experience in mortgage lending and banking. Don has a bachelor's degree from Cal State University Fullerton in sociology and a minor in history. And additionally, he is a licensed commercial pilot with multiple engine ratings. So as far as the program format this morning, our speakers will speak to each topic and will field questions at various points in the presentation. You'll be able to ask questions by typing your questions into the question box through the webinar portal on your screen. Please identify which island you're from, since each island's real estate is unique. So let's just get started. And Donald, you want to start?
Sure.
Okay, I'll switch seats here.
Nothing closer.
Okay.
Oh, we lost our picture.
Yeah.
I can't see myself, which is probably good because I hate looking at myself in a mirror or any other way. But good morning, everyone. My name is Donald Doan, and as was mentioned, I'm the Division Director of the Processing and Underwriting Division in the Santa Ana Homeownership Center. And Esther Yamashiro, who is a Mortgage Credit Branch Chief, overseeing the underwriter reviewers in our division. So as mentioned in the format, we would like to have an interactive type of format here. So as we go through some material, please feel free to type in a question, and then we will get flagged if that's, we can stop and address that, because we don't want to blow through this and then you forget your question later. So we think that's better, and we're going to go that way with this. So just a short overview where we're from. We are a regional homeownership center. There are 4 regional homeownership centers. Santa Ana serves the 8 western states and some of the islands. So we're responsible for customer service in that region, for ensuring the loans, FHA loans in that region. Outreach is a part of what we do. We actually have formal trainings that we go out and do a 2-day training. So that is very beneficial. We've also incorporated our condo training with the new rule and new guidance. And we have someone that does a fantastic job with that. It's at least a couple hours, and then a few hours of appraisal training, and then about a full day of underwriting training. So I know, the mainland's a long ways away, but it is good if you can get out there, or maybe we can come out here one day. That would be fantastic, and do that type of training. So FHA, our mission is getting folks into homes, but not everyone. Our market is first-time home buyers and minority first-time home buyers. We think that home ownership is a path to wealth that they may not have otherwise. It's a great product. We believe in what we do. 20% of the market currently is FHA loans. So we're already out there and strong. Part of the benefits in FHA loan is, again, it's relaxed, a little more relaxed underwriting guidelines, lower FICOs. We actually go lower than what most lenders will do due to credit overlays, but we will go lower than most lenders. The biggest thing I think of with FHA is the down payment. So, maybe you don't have much money saved, maybe you don't have any money saved, but you can still get an FHA loan. So you have a typical lower income borrower that has found, let's say, a condo, and they don't have much money saved. You can have an entire amount as a gift. And, usually that's a family member. It could be that, it could be a down payment assistance or other government entity that can provide the down payment. And then with seller concessions, if that's part of it, they could truly walk in with almost nothing down. So that's huge, and that helps folks get into homes. With that 3.5% down, there is a higher amount of risk associated with these loans. We are from the government, and we want folks to have home ownership, but at the same time, we got to make sure that we're solvent, and the mortgage insurance premium is a little higher on those high the loans with less equity, and that mortgage insurance premium that's paid monthly stays on for the term of the loan. So unless they refinance that loan, that will be on there. So that's a downside, but it's at the same time, if they can get into their home, get some equity, refinance the loan in a few years, it makes sense. Every day we're getting about 3,000 folks and their family members every business day into a home. So that's about 9,000 people per day across the United States through an FHA loan. We believe that condo homeownership is a path for folks to get into homes. We're from California. It's in some ways a lot like Hawaii. It's very expensive. First-time homebuyers trying to buy $1 million home is insane. So it's almost impossible. But buying a condominium is a path, and that's one that we're seeing more of. And we think that applies here in Hawaii as well. We have some new condo guidance based around the condo rule that we'll talk about in a little bit here. So we think that will be helpful with the single unit approval process that mortgagees, lenders have the ability to do on a single unit. Rather than getting the whole project approved, you can just get one at a loan level where the DE underwriter will be able to sign off that documentation. So that's a little bit more power in the lender's hand. Also, we do a lot of HECMs in our region. We do HECMs, as many HECMs as the other 3 homeownerships combined. So we do half the amount of all the HECM business. Hawaii is good for HECMs, and so we'll talk a little bit about that. Finally, I just want to talk about our customer service, and please write this down. You'll actually get it in your materials that are going to be sent to you, but 1-800-CALL-FHA. Or if you don't want to look at the buttons on your phone and figure out what the number is, it's 1-800-225-5342. So that number is our customer service number. Every month, our region, just Santa Ana region, gets 20,000 calls and emails. About 4,000 of those are escalated to the Homeownership Center due to the complexity or the nature of the call, and then we handle those requests. So we're doing a lot of customer service, and we like doing that. By the way, we are the best out of the entire nation for FHA, we have the fastest turnaround time and quickest response. So you get the benefit of that. But you can call us regarding our programs, anything we discussed today. You can also, if there's something at a higher level that you're not getting satisfaction with, you can contact Ryan and he'll give you information later, or it'll be in the materials sent. We do have questions. So the first question is, you said for minorities. Are you saying this is only for minorities? No, it's not only for minorities. I had my first home loan through FHA, and I am not classified as a minority, but that was huge for us. And I remember that we were renting an apartment under my first child. He was not even a year old, and we were looking for another place to rent that was bigger. We found this townhouse. It's 130 grand, which is not happening anymore in Orange County. But we looked at it and we said, you know what, we could make another $200 a month payment. And we talked to a realtor, and we didn't know how we're going to do it. And he said, no, you can do FHA. And so my parents threw in the money, and that's how we started owning our homes. So it's not just for minorities. It's really for anyone that's trying to get on a path to home ownership. Statistically, minorities are underserved, so that's why we mentioned the minority demographic. So thank you for that question. So we're going to go over a couple of our programs and talk about the condo guidance that's been updated. So I don't know, can they see this slide? Okay.
Yes.
So this is an approved PowerPoint presentation from headquarters, and the date's a little old, but the information is still very relevant. Okay, so we can go through the slides, but I'm also going to talk a little bit about this. So every time I mention this, since we've been on our Hawaiian tour, I've seen some heads in the audience blow up. Like, they can't believe what they're hearing. But this is all true, and we insure this type of loan. So this is, the 203H is a disaster loan. It's for disaster victims. And it's an amazing product. I mean, obviously you have to have the disaster. It has to be within a federally, presidentially declared disaster area. So once the president declares that area as a disaster, you have a year to obtain a case number, an FHA case number, to start the loan process. So for example, it happens, and then on day 364, the lender gets a case number. You're good, for the time it takes to process the loan. It's 100% financing, so that's amazing. And, they just lost their house where they were living. They probably don't have the funds that they need, so they can pick out a house anywhere for 100% financing. They can choose to rehabilitate or rebuild the house that they lived in, or they can move to a neighboring area, or they can take this program and go to California, Atlanta, Georgia, anywhere in the United States. So it's not, they're not restricted as far as where they can go buy, and it can be any amount up to our FHA limits. Another amazing thing about this is it's not just for folks that had a home where they owned it, and it was an FHA loan. It can be any type of loan on that house, and it can even be a renter in an apartment or a home that was destroyed by the disaster. So they can take this loan and go wherever they'd like with that. The underwriting guidelines are relaxed because the goal is to be able to get folks into homes, and we realize after a disaster their credit is going to be not in great shape. Most of the time the mortgage is going to slide because they're paying the money to live in a hotel, which can be very expensive. So we recognize that, and we kind of exclude that that credit review. There's some other great things about this program. It's within the PowerPoint slide. Another amazing thing is if they own the home and they had a mortgage on that loan and the house is destroyed, HUD or FHA just wants to see that The hazard insurance is working with the servicer lender to resolve that. We just want to see that it's underway. It does not have to be resolved. We don't check to see that the insurance is sufficient to cover. We understand that that could result in a deficiency where they could owe money. But again, the point of this program is to get folks back into a home. They just had their home, they were making payments on it, they lived there, they were happy, they lost it. We want to find another home for them because we are the government. So do we have any questions on that? Did anything pop up? Okay. If you're not familiar with this, obviously now in Hawaii, maybe it's not a factor, but if there is another disaster, hurricane, lava flow, what have you, I'd keep this PowerPoint on hand, keep this program in mind. Call our 1-800-CALL FHA. You can speak to us about it more. Speak to your lenders about this. We're finding that lenders are very conservative. This program scares them. We spoke to some DE underwriters yesterday, and they just can't believe it. It just blows their mind. So it's real, and we'd like to see people get into these loans to help them out. And we are very lenient on these loans that are insured through this program. So it's a great program. So I think Esther is going to discuss, what are you going to discuss? The 203K.
Good morning, everybody. As mentioned before, my name is Esther Yamashiro, and I am a mortgage credit branch chief. And I'm going to discuss some of the points of a 203K rehabilitation mortgage. So Section 203K, it's a rehab mortgage which allows the homeowner, borrower to rehabilitate their home and have it be in a single loan process. So they can add the cost of the rehabilitation to their mortgage, and it is then based on the after improved value of the structure. The property in question does not have to fall into a disaster area, particularly a presidentially declared disaster area. So it could be used for other disasters that do not rise to that presidential declaration degree, or it could just be for someone who's buying a property that needs a little love and attention, or it could be for the homeowner that wants to add some square footage, put some new windows in, put a new roof on their house. 203K is a great vehicle in order to accomplish that. So again, buyers can purchase and make improvements after closing. Current owners can stay in their home and make the approved changes after closing. And again, it combines the cost of the mortgage with the cost of the rehabilitation. So how is it different from traditional mortgage? Basically, a 203K may not meet minimum property standards or requirements at closing. That's the point of the rehabilitation. Of course, the costs are financed, and we use the after improved value. And 203K is a single loan, so they're not having to think about modifying after closing. It is closed, and that's the mortgage going forward. Okay. There are two different types. The first one is a standard. And you can use it for any type of repair or rehabilitation. The limited 203K it's limited in loan amount and is also for minor remodeling and non-structural repairs. So let me give you a quick example. I reviewed a loan early in my career at HUD, and this 28-year-old gal, fresh out of law school, bought a single family, and it was a dump. It was filled with graffiti. Walls on the inside were falling down. She raised it to the foundation and turned it into a fourplex. She probably never has to make a mortgage payment for as long as she owns the property. So that's a great example of the use of a 203K. So I have a question here that says, does the structure need to be permitted prior to the 203K? since it's based on the after improved value, it doesn't, your additions or reconstructions, you can get the permits after closing.
Yeah, I had a friend that he bought a place in Garden Grove, and he took me to this place. I'm like, are you sure you want to buy this place? Like, you put your foot on the door, you know, the walkway up to the door, and your foot literally went through the wood. So, like, okay, but he told me, you know, he's getting a 203K, and this is like 25 years ago. I'm like, all right, hopefully that works out. And it did. It was great. I mean, it looked beautiful by the time he was done. So,
Yeah.
you know, if you find those fixer-uppers and you get a little bit of hesitation, but it's priced right, they can get these 2 or 3Ks, and the value is going to be included, and
Right.
you're going to have a nice home. So.
It's a great tool. You can't use it to put in a pool. Okay, I need to say that up front because we get asked that question a lot. 203K, either version of the 203K, it's not for quote unquote luxury items. And I know that term luxury is relative, but a pool, for example, would not be an eligible item to finance for 203K. So these are the features of the standard 203K. It is subject to the normal FHA LTV limits. So on a purchase, it's 96.5. The buyers are still going to have to make that 3.5% investment, subject to normal FHA guidelines. The maximum allowable amount is, there is no maximum up to the relevant county limit in which the property is located. It's good for 1 to 4 units. It does require the services of a HUD-approved 203K consultant. That consultant is going to coordinate the rehab between the contractor, the borrower, and the lender. All of those parties need to work in conjunction with each other to get the rehab, the remodel done according to guidance. Again, you can raise the structure to the foundation, but you have to include the original footprint of the original structure. And of course, it can be used in conjunction with residences in a presidentially declared major disaster area. And the borrowers may be displaced from the home for up to 6 months, and the mortgage payments may be financed in the loan amount. So that is a big plus as far as that's concerned. Okay, a limited 203K, you're going to be limited to a $35,000 rehab amount. Again, it's all non-structural. You want to put new windows in, you want to put new roofs on, you want to put a new driveway in, and the borrowers can be displaced up to 30 days. The big plus is that you don't have to have a consultant, because that consultant, the fees for the consultant can be expensive depending on the cost of the rehab. And there are no inspections required if your repairs are less than $15,000. So these are some of the major differences between a standard and a limited 203K. You'd have to look at your property and determine which one is going to be most beneficial to your client. Again, a standard is going to be more involved because you're talking about major improvements and repairs to the property. So these are some references. The 4000.1 handbook is our single policy reference guide, and in it there will be the complete guidance for the 203H and the 203K programs. And of course, if you go over these guidelines and still have questions, you're more than welcome to contact us at the Homeownership Center. I have a great team of underwriters who can give you any and all information you need to know about these programs. So please, if you have any questions, we encourage you to contact us. And you'll be getting this PowerPoint presentation, and here is all the points of contact. We have a knowledge base that's available 24/7, 365. You have to put in the right keyword search, but it has thousands and thousands of FAQs that a lot of times can answer your questions. If you have specific issues, you're always welcome to email us at answers@hud.gov. And also, again, as Dawn mentioned earlier, the 1-800 FHA number. But again, you'll be getting these references in the PowerPoint after this presentation. Do we have any other questions? Okay.
Sure, so we have one. Is the 203K repair amount really limited to $35,000?
If you are doing a limited K, the rehab amount is limited to $35,000. If you do a standard K, you are not limited in the maximum you can finance up to the county limit. Okay, if that's all the questions, then we'll move on. Do you want to do condos next?
We can do that.
Or do we have another question?
We got a couple
another
more
question?
questions, yeah.
Okay.
So let's see. Can an FHA loan work in conjunction with 203K?
203K is an FHA loan, so it's the standard underwriting guidelines. So it's just like a regular FHA forward mortgage. You just have the rehab component, which is in addition to the normal underwriting and qualifying guidance.
Yeah, it's a first mortgage.
Yeah.
FHA does have a second mortgage, it's a Title I loan, but that's up to $25,000, and we actually don't monitor Title I loans, but those are home improvement loans that you can have a first and then have a Title I behind it, which is also a selling point if you're buying a home. There's nothing structurally wrong necessarily, but they want to do some improvements. You can say, you know what, get into the home, and then you can get a Title I loan and make some improvements that way. Again, you can't do a swimming pool or whatever, but you can put new windows in and that stuff. So.
Another one is, can you have more than one 203K? What is the PMI?
The mortgage insurance factors are the same as a regular forward mortgage, so it's generally speaking is 1.25% upfront on the base loan amount, and then of course you have the monthly premiums for the life of the loan. I'm sorry, what was the other half of that question?
What is PMI?
Can you have more than one?
Oh.
Well, typically we only allow someone to have any one at any time, any one FHA loan. So if you had a property and you did a 203K and you would have to finish, construction would have to be complete before you could get another FHA loan on that property. Like any other FHA borrower, typically you would only have one FHA loan at any given time unless you qualify for one of the published exceptions in the handbook. I hope that answered their question.
There's there's another question that I think is more applying to the condo side, but that you'll cover later. But what is the current owner occupancy minimum for an FHA condo loan? Do you want to cover that when we get to condo?
Yeah.
Yeah, I mean the short answer is it's 35% for an approved project, and then 50% for a single unit approval. But we'll get into more of that. There's always exceptions here and there. So.
Next, where do you find the county loan limit?
Okay. If you go to the HUD.gov website and you search FHA loan limits, it will take you to a page where you can type in based on the county. If you type in based on the state, it will give you all the counties for that state. If you are looking for a particular county in Hawaii, I may be able to give that to you. Okay, in Hilo for a one-family dwelling, it's $391. In Honolulu County, it's $721,050. On Kauai, it's $713. and in Maui it's $690. Those are all for one single family dwelling units. It is broken up by county, and that would be applicable for every state. If you search by state, it'll give you the breakdown by county.
Yeah, something to note too, that's for a single family residence. But once you start getting into 2, 3, and 4 units, that goes up quite a bit. So say in Honolulu, it's $721,000. If you get a duplex, it's $923,000. And a 4 unit would be almost $1.4 million. So depends on the property type. And we in single family do 1 to 4 units and condominiums.
Next, where can we access the FHA guidelines?
Also available on the HUD.gov website. In the search bar, you're going to search for HUD clips, then go to handbooks, and then it will list the handbook by number, or you can just do a search for the 4000.1, and that should take you to the relevant link.
Yeah.
And find the handbook that way.
Yeah, it's a PDF, so
Yeah,
you
it's
can
a
download it
PDF.
and have it on your desktop.
Let's see, is there any cost to sellers for FHA loans?
There's not any additional cost to the seller. FHA got rid of that rule a while ago.
Another question was just a repeat request for what the monthly PMI is percentage-wise.
I don't know what the exact percentage is because that may be based on your LTV. But that is posted in the handbook.
It's going to be higher than a conventional, but then again,
Yeah.
you're doing 3.5% down most of the time. But I believe it is based on your loan to value, and 95% of the time it's 96.5% LTV.
Right.
That's why we get FHA loans.
So there's 2 types of MI on an FHA loan. There's the upfront, which is right now 1 3/4% of your loan amount, which is financeable in the loan amount, and then you also have the monthly. Okay, so we're moving on to the condo. Yeah.
Yeah. I'm not sure we have a PowerPoint that we're going through on this,
No,
but
I don't think we have a PowerPoint
No.
particularly.
it's pretty extensive, the PowerPoint for the condo. So I'm going to give you the highlights.
Yeah, that's fine.
So we had a condo rule established a while back, and what we do with those rules is we establish guidance around that, and that took a while. I mean, we've been waiting quite a while for this new condo guidance, and lenders have been waiting for this because the old spot approval, they wanted that back, and we liked it too, and it was helping folks get into homes. And so we don't call it a spot approval anymore, although Ryan has called it spot approval and some other folks have. It's called a single unit approval, or SUA. Some semantics, but so a couple things changed. Every state's a little different with condominiums, and when they're developing policy in headquarters, they will take our recommendations, our observations from our region. And, of course, we're concerned about Hawaii because it's different than other regions. And we made our recommendations. There's some things we liked, some things that we're still working on, and we are pushing to hopefully get some of that changed. And we think we'll be successful eventually. First of all, there's like over 150,000 condominium projects in the United States, and only 9,900 are approved. So that represents about 6.5% that have FHA approval. When we do full condo project approval, we charge $0 and 0 cents. So it's free for us to approve the project. That's not to say that the associations won't charge you for documentation, but if you get the entire project approved, that's one more resource you have for getting folks into homes. So we believe it's worth it. Upside on this is the project approval went from 2 years, now you have 3 years before you have to do a recertification. So we get an additional year. Of course, the SUA is now part of this. That's great. We removed the requirement on new construction for environmental reviews, which everyone did not like, including us. It's very in-depth, takes quite a while, and costs money. So now we rely on the builder's information and local jurisdiction information. So we got rid of that, which is good. We also changed the definition in a site condo, which is an upside. Previously, it was one building for one lot. And now you can have multiple buildings on a single lot as long as it's detached. And I'm sure we'll get some questions on that, which we can answer. That information, when or if you download the PDF, is on page 496. That explains the site condo definition. So there's condo project approval, and then there's the SUA approval. Condo project approval requires either a DELWRAP entity, which is basically we delegate that entity to underwrite and review condo associations and approve them in the FHA connection. That's one route. The other route is now we have this SUA process, or you can send it into the HAWC and we'll review the project. And by the way, so in our division, we have about 10 condo review experts, and they're fantastic. They know everything about condos. That's what they do all day long. And we used to go from 20 days condo project approval. And as of the last few years, it's been around 3 days project approval, which is fantastic. So you get us the information that, on this questionnaire, or your submitter can do that. And within a few days, we're going to have an answer for you. And if the answer isn't favorable, we're going to call you and we're going to work through it and see if we can resolve some of it. We don't want you to be left alone out there trying to figure out why it wasn't approved, which is kind of what we did in the past. We don't want to do that anymore. We want to get these associations approved. So if you decide to go HRAP, which is sending it into the Homeownership Center, you can call us and ask us about that process, and we will work with you to get that done. So if you do a project approval, full project, you need 50% 35% owner occupancy. You have to have a minimum of that. We're trying to develop communities where people live there. That's important for FHA. We have a max of 50% FHA concentration. We don't want to be the sole solitary lender in the complex. Years ago, we became the board members for some condo projects because we own most of the homes in that. So 50% is it. There's a new form. It's a questionnaire form associated with the condo project approval. It's a 9992. It's 13 pages. And then there's a 9991 for the single unit approval, which is 5 pages. As I mentioned, you got 3 years with an approval before you have to recert. And then we consider anything less than 1 year completed for the certificate of occupancy, new construction. So if it's less than a year completed, it's considered new construction. Okay, so on to the single unit approval. So single unit approval is designed for projects that are not approved. And those can include projects that are rejected for whatever reason. In Hawaii, you've got a mix of leases and fee simple. That could be a reason. There could be other reasons where you could not get a full project approval, but it'll work on a single unit approval. A single unit approval is a loan level mortgagee/lender certification. So the delegated underwriter is going to review the condo association documents and confirm that it fits to our guidelines, sign it off, and that's your condo approval. So for the lenders, you have to have a total accept. When you run it through the engine and it comes back, it's got to be accept. If it's not accept, you can still do a single unit approval, but it's a max of 90% LTV. Again, I'm only talking about the single unit approval right now. You need a minimum 5 units, max 10% individual owner if it's greater than 20 units, and max 1 unit if it's less than 20 units. So we don't want one owner buying up the project. So 10% over 20, 1 unit less than 20. Max FHA concentration is 10%, or 2 units if it's less than 10 units total. This is a little higher on the owner occupancy. As I mentioned, it's 50% owner occupancy minimum. And you need to complete that 9991 questionnaire. So overall in Hawaii, and that's kind of the SUA, I'm going to go over how to get that process going. I shall do that now. So when you have an SUA, you looked at the documentation, it looks like an approvable SUA. You take the information from sections 1, 2, and 3 on that 991 form, or the lender will, submit it to answers@hud.gov. They'll route it to the Homeownership Center in Santa Ana, and then we're going to check for a couple things. We're just going to check for the single owner concentration. We're going to check for the owner occupancy amount, and then we're going to make sure it's not really approved. And that sounds simple enough, but we have a large amount of SUA submissions where the condo project is already approved. Maybe it's under a different name, like it's slightly off, or the name is different in our FHA connection system because for whatever reason, but the tax ID information isn't lining up with the name. So we check that. And then that's it. The rest of it is up to the lender to certify the information and go that way. And so we're giving them more power to do these loans. So that process is, and I'm sorry, so the reason for that is when the lender picks, when they get an FHA case number and it's under the SUA process, it immediately goes into holds tracking. Basically, it's held until we release the hold. So this process releases the FHA connection or FHA case number hold, and then the lender can proceed with the loan. So we have a question: can an agent get a project approved before getting an offer, or does it need to be submitted by a lender? Yes, you can get it approved before you do that. We actually, I think Nancy, when she used to do these outreaches, that was her angle. She was trying to work with realtor associations and sales professionals to try to get that done. It's free for us, but there is a cost for some of the documentation most of the time. But the short answer is yes, you can do that before getting an offer. And as far as a lender, it doesn't have to be submitted by a lender. We have DELRAP folks that do that. We have attorneys that send in information. But take a look at the 9992 form and review the documents there, and you'll kind of see what's needed. But these associations have all that information. They just need to get it to you somehow. Okay, so leasehold. Do you finance leasehold? Yes. So for projects with a leasehold, the condo association has to be listed on the lease, not the individual owners. That's on page 495 if you want to review that. We understand that there's a mix of lease and fee simple, and that's kind of a case-by-case review. What were the notes we had on that as far as that question that came up and Julie addressed on that? Do you remember?
Well, if you have a project that's mixed fee and lease, and that was why it could not be approved, that is where the single unit approval would be beneficial for those fee simple owners.
Right.
And we have escalated the possibility of getting some wiggle room in getting those leased units eligible for FHA, but that's still under consideration right now.
Yeah, so we've escalated that to headquarters for review. A couple of the challenges with the condo guidance related to Hawaii are the leases and also the required fidelity insurance. So the fidelity insurance is not a factor for most of the rest of the company or country. I mean, it just didn't work that way, and that's probably why headquarters just went with this new guidance. So in the past, it was the fidelity insurance had to cover 3 months assessments, all the assessments, 3 months worth, and reserves, or whatever the state mandated coverage was. And it was either or. Well, now it's the greater of those two. And for Hawaii, that's become a little problematic. The good news is that's not statutory, that's not written into law. That's something that HUD has built around that. So we're working with headquarters on this one as well to try to get some room in there. And we think that we will be successful, but these things take some time. So again, if you call 1-800, call FHA. We got a great team that can assist you with some of this stuff, and we can see if there's anything that we can do for you in those cases. So we got another question. Is there a list of approved projects online for Hawaii?
Yes, if you go to Google, I don't know how we did business before Google. You go to Google and search for FHA approved condominiums. It'll take you to a search engine page, and you put in the state of Hawaii and go down, and I think the type would be approved, and hit send. It will give you a list of approved projects in the state. It'll be a good idea to check that when you're looking at any type of condo unit. The other way to narrow down that search is if you use the zip code. A lot of times that will narrow your search to your particular area, make it easier for you to find out whether your project is approved or not.
Yeah, one more thing to mention on the fidelity insurance, that's only for 20 units or more. So if you have a project that's less than 20 units, you can disregard that fidelity insurance requirement. By the way, we have, and I believe we'll send this out to you, we have 3 webinars that are related to the condo guidance. They're about an hour long each, and they all have PowerPoints associated with them. We have those PowerPoints, but they're extensive, and that would be the extent of our presentation today if we went through those. So we encourage you to look through those or forward that information to a lender, especially the single unit approval, to get them comfortable with that. And again, they can always call us, and we will work with them on doing that. So that's the overview for the condo. Do we have some questions for?
Yeah, so next, what is the current owner occupancy minimum for an FHA condo loan?
It's the same. Oh, I'm sorry. What did you say? Owner occupancy?
For an FHA condo loan.
Oh, okay. So it's 50% for the single unit approval and 35% for a project approval.
And then next, would projects that have 20% timeshare units qualify?
Yeah, we're concerned about transitory folks. So let me think. What was the question again? How many?
Yeah, so would projects that have 20% timeshare units qualify?
At this time, I would say they would not be eligible due to that transitory portion. So
this is a great question to call 1-800-CALL-FHA because we have experts sitting there that can answer this question. The details of what they do versus our knowledge right now is immense. They know a lot. And this just came out a few months. We're still in the beginning stages of this SUA approval. But I would encourage you to call. We can also get the information and send out the answer in a group. We're fairly confident that that's not something that would be approved, but I want to make sure that we have the right answer.
Next, VA approves such projects.
Pointing out that the differences between FHA, VA, even USDA RD approvals.
I have no
We don't
knowledge.
know. We only know
I
FHA.
have no knowledge.
That's enough to try to know all that. Oh, okay. Any other questions on condominiums that we can try to answer? By the way, we did meet with local submitters, attorneys, associations a few days ago. And it was a really good discussion. We actually had our condo expert on the phone back in our homeownership center. And she was very good at answering all the details. So again, that resource is there if you want to call and ask some of these questions, or even email if you don't want to speak to anyone, just answers at HUD.gov.
Okay. Should we do updates?
Want to do HECM or updates? We could do the HECM program, like an overview of the HECM.
The far one, yeah. Okay, so HECM short is the acronym. The government loves acronyms. Is the home equity conversion mortgage, which is FHA's reverse mortgage product. Basically, it allows seniors to access the equity in their home. You have to be 62 years of age. We're looking at seniors who have spent their whole lives paying off their mortgage. They're now sitting on a property where they don't have a mortgage, but they can't access that equity, and they're living on a fixed income. So this loan was conceived during the Reagan era, and its purpose was to allow seniors to age in place. It gave them access to the equity in their home in order to help them do that. The borrowers do not make a monthly mortgage payment. They still have to make sure that the taxes, insurance, and all those other property expenses are paid. And it is, of course, a rising balance loan. Interest accrues monthly. Mortgage insurance accrues monthly. Probably one of the major misconceptions is on a reverse mortgage, the borrower retains ownership. FHA does not have an ownership interest in these properties. The HECM is a cash flow. We're looking at the cash flow of the borrower. It's not FICO or ratio driven. And if the borrower elects to get loan proceeds dispersed to them monthly or on a occasionally, as the program allows, the lender is responsible for doing that. Okay.
So I don't know if this is related to condo or what you're just speaking about. Could be.
Okay, so the HECM maximum claim amount is based on the lower of the sales price, appraised value, or national loan limit. Now, the national loan limit, this has a minor typo in it. It's 765,600. So that is the four loan limits that I discussed earlier do not apply to the HECM mortgage. It is 765,600. That is the national loan limit for 2020. So if your home value is at 850, the maximum claim amount would be 765,600. And that maximum claim amount plays a big part in determining how much money the borrower has available to them. So that number is determined by the maximum claim amount, the age of the youngest borrower on the loan, and the interest rate. Factor is applied and a dollar amount is reached. Financial assessment is the qualification, quote unquote, under which the borrowers have to go through in order to become eligible. So we're going to look at their credit history. We're going to look at how they paid their property taxes, and we're basically looking at how much do they have left over after paying all their expenses. How much do they have to put gas in the car and put food on the table? Okay, so that's what we mean by a cash flow loan versus a FICO ratio issue. Financial assessment is required for all HECM loan types. It's a recent addition to the HECM qualification product. We used to joke that the HECM loan previously was a fog the mirror loan. As long as your property value was there and the borrower fogged the mirror, we didn't care about anything else. But HECMs have went through a bad time when the market crashed, and HUD put out a lot of money in paying off claims. So in order to sustain the program for the long term, they had to apply new guidance and have some qualification in there for the borrower, because HECM is not a one-size-fits-all. You can't just put everybody that comes along into it. It has to be the right product for that borrower. Okay, and that is the lender's responsibility to determine. So these are the types of transactions. You can actually purchase a home using a reverse mortgage or HECM, and that's a recent addition to the HECM portfolio. That came out in 2009, and we probably don't use it as much as we could. The lending community is probably not using it as much as they could be using it. So if the borrowers choose to get an adjustable rate, there are different ways in which they can receive their money. As long as the math works out, they can get monthly payments for a fixed period. They can get monthly payments for as long as they live and remain in the property. They could set it up as a line of credit and draw only when they need the money, or they can have a combination of both, and that is the flexibility of having an adjustable rate HECM. Fixed rates would allow the borrowers to get the most money possible, but they could only get it in a single lump sum. So the upfront MIP is 2% of the maximum claim amount, so that is significant, but the monthly is only 0.5% of the outstanding balance. Okay.
Yeah, just a reminder, there's no payments, and this is all just happening in the background, and the loan balance is getting higher. So.
Right. So here's some bar eligibility. Again, they have to be 62. They hold title to the property. They must occupy that property as their principal residence for the majority of the calendar year. They can't have any delinquent federal debt. They can't be on the excluded parties list. They have to have HECM counseling. And I understand right now we don't have an approved HECM counselor in the state of Hawaii, but we met with some counseling agencies yesterday, and they indicated that there is an intent to have a couple of their staff approved to become HECM counselors. So that is something that's out there. I think it would be great for the HECM community in the state to have that local borrower who can pronounce the borrower's last name and their street and their city, which sometimes those national companies, they just aren't familiar enough with the state. There are certifications, and of course the borrowers have to meet financial assessment. So how does HECM get paid back for the loan? Basically, once the last remaining borrower, we'll go over this a little bit later, but either passes on or leaves the property is liquidated and the loan is paid back. Okay. Eligible non-borrower spouses. This was a problem back when the market crashed because the funds available to the borrower is based on the age of the youngest borrower. and you have to be 62. So there were times either they wanted the most money, so they didn't have the younger borrower on the loan, or the spouse wasn't age eligible. There was a spouse that was not age eligible, so they took that spouse off the loan. Well, when the borrower passed, the loan became due and payable, and the value of the property had plummeted. And although they had the option of repaying debt, they couldn't because the property did not have enough value. So FHA instituted some guidelines that said if they were married at the time the loan closed and the non-borrower spouse occupied the property as their principal residence and continued to occupy the property as their principal residence, and they declared that, they could be be eligible for this non-borrower spouse deferral period. And what would that mean is that the eligible borrower passed away, the non-borrower spouse could remain in the property, and the HECA mortgage would not be called due